demand. In an up, if market is in an uptrend, giving you higher high, higher low, you should be looking for buy continuation. So in your buy continuation, you should be looking for demand zone. That is, price is demanding for that product. They need to buy it. That's what demand basically means. So in an uptrend, you should be looking for a demand zone for price to retrace back into, then you will buy from the demand zone. That's what the demand is all about. And you can also call demand and supply, you can call it order blocks. They all mean the same thing. You can call it order block, or you can just call it demand or either supply. So that's for the uptrend. For the downtrend, you should be selling in a downtrend. Now, if the downtrend, you should look for your supply zone. Your supply zone will always be at the high, your demand zone will always be at the low. For beginners, I'll not advise you to counter trade. If it's not a signal I'm dropping, please do not counter trade. Always follow the trend of the market. Always wait for it to go back to your entry and enter the sell if it's in a bearish market, or always wait for it to go back to the demand zone to buy.
My
Follow the trend,
goodness.
not the one that market. Please mute your mic. Oh. Not the one that market is buying. You'll be looking for this selling pressure, because you will not know when this selling pressure is over. It can just sell a little bit, go up like this, take out your SL, then still come down and keep buying. So I not really advise, unless you know you're actually good, that yes, you are certain that it's actually going to work out. That is when you can actually. But for beginners, I not advise you to please counter trade the market. So now, that's what supply and demand is. Now, how do you find your supply and demand? There are three criteria to find your supply and demand. The first one, or let me just call it order block. Let me use order block. There are three criteria. The first one is, like I said yesterday in the class, I taught you guys break of structure and fair value gap. So for a break of structure, you understand, price action needs to break the recent high. First The first criteria is a break of structure in the market. The second one is your fair value gap, which I said the candle before, when there's a gap between three candles weak like this. If you guys remember yesterday class, this three, the gap between the first candle wick and the third candle wick is your fair value gap. Now, what is fair value gap? Fair value gap acts as magnet in the market. It draws price into it, or to just tap it and keep selling or buying. That's what fair value gap acts as. So now let me take this down. So you have this break of structure here. The second criteria, don't forget, I said the fair value gap. So your fair value gap will be somewhere here. And the last criteria is the candlestick before your fair value gap. Please mute your mic. The candlestick before your fair value gap is, who is this now? So the candlestick before your fair value gap, don't forget, the candlestick before your fair value gap is your order block. So that's just how it is. Now the third criteria is the order block you've marked. Once price is buying, you need to make sure it has not mitigated it before it start buying. Like what I mean by mitigate it, you need to make sure price has not tap into it like this before it breaks this structure. You need to make sure this has not happened. That's the meaning of mitigation. So the first criteria I said is a break of structure. You can either have a break of structure or a change of character. If price action breaks structure or it change character, whichever one. The second criteria is you need to have your fair value gap. Now the third one is it must not be mitigated. It must be unmitigated. So now this is how you look for your supply and demand zone in every market, be it crypto, synthetic, forex market, stock market. This is how you find your supply and demand zone. Because how do you find supply and demand zone? It's telling you before this whole buying movement happened, a before this whole movement happened, there was a this thing happening here. There was consideration happen around this place that this is where the last it broke structure. If this is where the last movement was made before it broke structure, there are still other blocks, there are still levels that price and tap into it. It will now give you a new structure. That's how plan move. It's move from supply to demand and from demand to supply. Please mute your mic. So like I said, it move from supply to demand and from demand to supply. So like I said, the three criteria to find your order block is a break of structure or a change of character, which is your BOS or chalk. The second is your FVG, or you can call it fair value gap, or you can call it inefficiency. They all mean the same thing. And the last one is it must be unmitigated. Now there are some situations whereby price action will use the fair value gap and start buying. This is telling you it's used the fair value gap for the demand zone in this uptrend. It's telling you use the fair value gap for the demand zone. So how would you know when to buy from here, from the fair value gap, or when to buy from the order block? That is where your confirmation candlestick come to place. Your confirmation candlestick come into place. Now, in an uptrend, you look for what they call a morning star. You look for what they call a morning star candlestick. This is what a morning star candlestick is. This is how it looks like. A morning star, you have a red, a green that sweep below the red, then you have a new green up. Like this, you can see this, you can see it here again. This is a morning star, this is a morning star. So this is what you need to watch out for on the fair value gap. If it gives you that fair value gap, you can enter your trade from there. And your stop loss will be below the wick of that candlestick with breathing room. You need to give it breathing room space at least. Now, what do I mean by the wick? This is the last green. If it has complete this red, green, green, your stop loss will be below here. I'm still going to show you an example in the chart. Your stop loss is going to be below here like this, below this area, because it's telling you this was where this last sellers came into place. Then buyers swept the liquidity before they started buying. So you need to make sure it formed this candle, this three candle before you enter the trade on the fair value gap. That's it for confirmation on a uptrend. I mean, in an uptrend rather. So now let's take this down. Do you guys understand what I just explained for the uptrend?
Yes, sir. Please,
And
please come
and
again. Please come again for the fair
and
value gap.
okay, the fair value gap. Fair value gap is a gap between three candles. When there's a gap between three candle wick, the wick, you can see this one, two, three. Now look at this first candle wick. Look at this third candle wick. There's a gap between them. It's not they are not close to each other like this. This one is not close to this one like this. You see, it's not close to it like this. It is far from each other. So the gap is what you are going to mark out as your fair value gap. Do you understand now? So you need to make sure there is a gap. It is that gap you call a fair value gap. Like this one again, this is one. Look at this one again. One. So it might be any color. It might be any color of candle. It's not compulsory. There must be black, 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 or green, green, green. It can be any color. Like you can see this one. There's black, there's blue, and there's under blue. The main purpose is you need to make sure there's a gap between the first week and the third week. You can see they are far from each other. So you mark it out like this, and this is where your fair value gap is. Do you understand?
Yes.
All right. So once price action has given you this, because we analyze on the 1 hour time frame, we use the 4 hour and daily time frame to check the direction of the market, and we analyze on the 1 hour time frame. That is where you start marking out your supply and demand and your fair value gap. Now, once you've done that on the 1 hour time frame, you go down to your 15 minutes or 5 minutes. That is where you look for that confirmation candlestick I said on the fair value gap. If you do not see that confirmation candlestick, do not enter the trade, because it's that confirmation. There are some cases it will not give that confirmation, but you still buy. That's what is going to be the discipline. You need to make sure you have a discipline that you must follow to become profitable. Because if you are just taking trade randomly anyhow, you are just going to draw yourself back. You need to have this discipline, and it's that discipline that is going to make you become profitable at the long run. So if you've seen it on the if price has gotten to your fair value gap on the 1 hour, you will then go to the 15 minutes or 5 minutes. You You then go to the 15 minutes or 5 minutes. That is where you look for your evening, your morning star rather. So that's it for the uptrend. Because if it not use this level, if it's not use the fair value gap, that means it eventually want to come back to your demand zone. But you need to watch out for the fair value gap because most use fair value gap. So that's it for uptrend. Now for downtrend, when price is giving you a low, a lower low, and a lower high. Like I said, the first criteria is you need to find a break of structure or a change of character. Let's say price has broken structure like this to the downside. It has broken structure to the downside. Then the second criteria, like I said, you look for your fair value gap. And the candlestick before your fair value gap is your order block or your supply zone. And the same thing applies here. Soon as price has come to your fair value gap on the 1 hour time frame, once it has gotten to your fair value gap on the 1 hour time frame, you go down to your 15 minutes or 5 minutes to look for a evening star. This time you are looking for evening star. So this evening star candlestick is the opposite of the morning star. You can see this is the evening star candlestick. You have the green, the red is going to sweep above the green, then you have an initial green. Because it's telling you buyers came into the market, then sellers swept the liquidity. That's where buyers are done and sellers are now in the market. So that's what you are going to look for on the fair value gap. 15 minutes. That's when you go down to the 5 minutes or 15 minutes to look for that fair value gap. Hold on, I'm coming. So the 15 or 5 minutes, we are going to look for the confirmation on the fair value gap. So if it's not using the fair value gap, high chance it wants to come back to the demand, the supply level, then to sell. Or if it's on the fair value gap, make sure you are ready on the trade. Now, some people do not know how to set alarm on their trading view. This is how to set an alarm on your trading view. You can see this black arrow here. So you set it on your fair value gap because you don't need to look. You don't need to just keep looking at your chart all the time. You don't need to keep looking at the chart all the time. It fucks up your psychology. You just set an alarm, tap on it like this, then you see add alert. So soon as price gets to the fair value gap, it will alert you that yes, price is already at your zone. You need to come and check it. So that is when you wait for the confirmation on the 15 minutes or 5 minutes. That's if you're using your laptop. If you're using your phone, just hold your phone down. If you're using any phone, just hold it down. You'll see add alert at that area and you drag it to your fair value gap or your supply level, whichever one. So do you guys understand it now?
Yes.
Yeah,
Yeah,
I have a
Do
question.
you guys
if we
When
yeah,
just
what's your
when
question?
the supply zone, do we still wait for the evening start, or we
Yeah,
can?
you need to wait for it. You need to wait for you to have a high probability setup. If you are entering from soon as you get to the order block and you just sell, there's a chance it might sell. But for you to be confident that yes, you have a lot of confidence that going, you can wait for the confirmation, evening star or morning
Okay.
star.
Sorry, I have a
Do you
question.
understand? Yeah.
So,
Yeah,
when
what's your question?
analyzing on the 1 hour time frame, is it possible that you can mark both your fair value gap and your other block, and you just wait to price hit one of them?
Yeah, once you've marked it on your 1 hour, you wait for price to get into the same 1 hour, you wait for price to get into it. Once you have
Yeah,
marked out and already inside it, what do you say?
I mean, what I'm asking is that is it possible you can just mark your both your fair value gap and your other block, then wait for price?
Yeah, you have to mark. It's on the 1 hour you are going to mark it.
Okay.
It's on the 1 hour you are going to mark it. Yeah, so let me quickly show you guys. So that's it for just supply and demand. It's just basically it on how to just follow it. People just tend to just complicate it. Now, to a top-down analysis is what you are going to use to analyze the market. A top-down analysis. First, we are day traders. We trade for like hours or few minutes. So the first thing you're going to go is go to your daily time frame to see who are more in the market. As you can see on the daily time frame, gold is currently in a consolidation market. It has been ranging. It's failing to break the low. It's failing to break the high. As you can see, it's ranging from this high to this low. It's just ranging. So taking this down, we'll go to the 4 hour, and what can we see on the 4 hour? So the 4 hour time frame is telling us it is also ranging. Is it ranging? Okay, we have the swing low, we have the swing high, then consolidation, take out this high, then give you, it's still ranging. It's ranging from this high and low. It's failing to give you a new break, a new change of character or a new break of structure. So it's still ranging on the 1 hour time frame. Then we'll go to our 1 hour time frame. So it's the 1 hour time frame we are going to start analyzing. So the first thing you do on the 1 hour time frame is to identify the trend of the market. Are there buyers in the market? Are there sellers in the market? Who are more in the market? So in this market now, we can see we are bearish. Price action is still bearish. We have this lower low, lower high, and a lower low. So you can see price failed to break this high and low. We are still bearish on the 1 hour time frame. Throughout last week and last 2 week, price has been trending because like end of the year. When it comes to end of the year in trade, the price action tends to trend to consolidate. So this is the recent break of structure in the market here like this, and price has been ranging from this high and low. So like I said, now that you've identified the trend of the market, the second thing is your break of structure, which is what I've marked here. We're in a bearish market, we look for a supply zone. Don't forget. In a down market, in a downtrend, in a bearish market, you look for a supply zone. So now that you've looked for supply zone, there are even some cases you see 2, 3 fair value gap. Just make sure you mark the last one. So you see this one fair value gap here, we have this second fair value gap here like this. So price action has used this one, so this one is no longer useful. So price action has even filled up this whole fair value gap. So it's still more of not useful anymore. So like I said, the candlestick before your fair value gap is your order block, which is this blue candle. As you can see, it is this blue candle price is currently on. So as you can see, soon as price action came into this supply level, it's sold from the supply zone. It sold from the supply zone. Now, I said there are some cases price action will start selling from the fair value gap. Let me take this order block out. This is your fair value gap. This is your fair value gap here. So this is the first thing that happened. Soon as price sold finish, it came into your fair value gap. So when price has come into your fair value gap, like I said, you go down to your 15 minutes or 5 minutes in a downtrend to look for a evening star in a 15 minute or 5 minutes. If you don't see it on a 15
Yeah.
minutes, go to your 5 minutes. So now that we are in a 15-minute time frame, you can take the 1 hour fair value gap out because we still have an other fair value gap inside here like this. Still have this fair value gap inside like this. So you just need to just keep minimizing your drawing. Don't just draw don't just be marking out any zones or trend line or anything because you get confused. There's something called analysis paralysis. When there's a lot of line and zone, you just get confused. You don't even know where your real line is or what you're actually waiting to buy or sell from. So on the 15 minutes, I can't find the evening star. We can't find evening star here, so it's not valid. Then you go down to the 5 minute and look for the evening star. If you do not see that evening star, you should not enter the trade. So now what can we see here? We can see price action gave us the evening star here on the 5 minutes. You can see it gave this blue. This candle is called a shooting star, or you can call it a inverse armor. There are different type of candlestick, but you just pick like four, or there are like thousands of candlestick. You can just pick four or just to just master it and be good at it. So this is what they call armor candlestick. The armor is always one straight up like this. It's always rejecting straight up like this, and the inverse armor is always the one that is always opposite. The inverted armor, as you can see, this is the inverted armor. It's always it's your mic. We are just joining also. This class went in the next 10 minutes. I'll send a new link to you guys if this class is over. So I'll send a new link to you guys. So, like I was saying, inside the fair value gap, we still have another fair value gap here like this. So you can take this one, this 15 minutes fair value gap, and mark out the 5 minutes fair value gap. This is the 5 minutes fair value gap. So as you can see, price action tap into the fair value gap. You need to make sure the evening star is complete. You can see this blue candle gave you this inverted hammer to sweep this high, then give this black candle telling you sellers are now in the market. So once it's done showing you this please mute your mic. So once you've gotten this hammer complete like this, like I said, your stop loss will be above this eye. You give it few pips above this eye like this. Above that eye like that, then you target a 1:3. A 1:3 means you are risking one to make three, or you're risking either you're risking 100 to make $300. Let's see. So this is a 1:3 like this. So this is where the ratio. This is what the ratio means. This three like this, it means you are risking one to make three, or you are risking 100 to make three, just times three of what you are risking. This is 1:2. It means you are risking one to make two, or you are risking 100 to make two. If you are risking a 1:4, you are risking one to make four. That's basically what risk to reward ratio means, RR, or you can call it RR. Now, before you take a trade, make sure you are taking a trade nothing less than 1:2. It must be 1:2. If it's 1:1, ignore that trade. No matter how many um um strategy you have that you've gotten that okay, this thing will sell or buy, do not enter the trade, because trading is all about following a plan. You must not ignore one plan that okay, because this is going to happen, let me just adjust my plan. No, you must follow your plan consistently. That's what's going to give you that edge in trading. So you must have nothing less than 1:2 to enter a trade. A 1:2 is still okay. You're risking 100 to make 200. You're risking. Please mute.
I just need to work.
So you're risking one to make two. But in my own cases, I always give at least a minimum of 1:3. That means I'm risking one to make $3. So don't forget, you look for your evening star on your supply zone and your morning star. I mean, your supply zone or fair value gap, and your morning star on your demand zone or fair value gap. Do you guys understand what I just explained now?
Yes, sir.
Or do we
Yes,
have
you
any
do.
do we have any question? If you have any question, you can ask now, because this class will end in the next few minutes and I'll send a new link. So let's take all of this down. That's just how supply and demand works. In our next class, we'll be talking about risk management. So let's take all of this down and just go through the weekly analysis, what you should be expecting for each pairs. You should be expecting a low volatility in the market. Markets might not be moving like a really long pips, but still we might still see a good setup. So like I said, we are still bearish on gold. We should be looking for sell continuation. The price is currently on the supply level like this. It's currently on this supply level. So let's tap on this supply level. We go down to our 15-minute time frame to look for entry. So soon as it has tap on the supply level, we'll look for a entry after after it has already
So
tapped on
sorry,
the
boss.
supply level. So we having yeah.
Can you just do a summary on what we'll check on the daily and 4 hours time frame?
The daily and 4 hour time frame, you just need to check the direction of the market basically. You don't really need to analyze more, or you check your zones that price action might likely expect, like support and resistance zone. Like this zone currently here. Let me okay, this is the daily time frame. Let me use the 4 hour time frame. This is your you have a support and resistance zone here.